Today's case study is real life net worth focused on equity compensation. A lot of our clients have some form of compensation related to stock in their company. And so they come to us with a variety of problems. Oftentimes, one of the first is, I don't know what I'm worth. I don't know where all the money's at. And so looking at their net worth on one page brings a lot of clarity to oftentimes a husband and a wife with lots of questions, sometimes some worries and anxiety of, I don't know what I've got.
That's exactly it. So the very first step is to get organized before we can lead with any recommendation. Hey, does that stock make up 2% of your overall net worth, or is it 30? What degree of severity are we looking at the situation? So that's our example here, and that's the page that you're looking at. So when we start working with any client, or we're making the context of any type of financial recommendation, we want to understand comprehensively what your entire picture looks like, so that we can fully understand. After reviewing and compiling all of the data, in this particular case, their current stock allocation in a single position was around 15% of their liquid net worth. Anytime that we're trying to understand an equity compensation, we also know that there is a vesting schedule component to it, because in all equity situations, there are vested shares that you have access to today. That's referring to the 15% number that we just talked about. However, your unvested allocation is as equally important, because it drastically increases potentially your overall concentration to that individual stock. Because once again, as a quick reminder, that is your job, your sole source of employment as an individual, your current stock that you hold in the company, plus your unvested shares to come into the future. So the very first thing that we build is your vesting schedule to understand what could be, what is currently coming to you and what could be coming to you in the future, as well as the other relevant data around grant price and so forth as well, and when we run these specific calculations. After looking at your vesting schedule, we understand that that only answers a particular part of the question. The next question is, how much stock can you sell while maintaining a particular tax bracket? So which we're able to run calculations that help optimize around a particular tax bracket, which then we can actually back into a share count based on today's price. In this case, we were looking at selling close to 4,000 shares while maintaining the 32% tax bracket. We also understand tax brackets don't really tell you every single answer that you would like to know. One being, okay, great, I'm going to get this bundle of cash. How much of it is actually going to be mine after taxes? And so that's the next calculation that we look into. The total proceeds of the sale in this particular case was a little over $200,000, but we also calculated the tax so that they were able to understand that their after-tax proceeds were around $157,000. But the most important thing, and the whole reason for this exercise, is that we were able to lower their concentration from around 15% to close to 7%.
Situations like this remind me that stock compensation is oftentimes like a deer in headlights. It's oftentimes the do nothing, right? They've got this thing, they've got more shares next quarter and next quarter, but they end up doing nothing. And so oftentimes what strategies and workshops and meetings like this allow us to do is say, here's how we're going to address the already existing shares, and let's build a strategy to make sure that as the stock pops, as the stock moves, that you're maintaining a comfortable level of stock exposure to your employer, to the sector, among all the other investment opportunities you have with cash, real estate, and anything else that you want to invest in.
And to take that one step into additional detail, Josh, and that would be, in this scenario, we actually located each lot to sell to further clarify, to further move forward with, because through each one of these pages, our goal is to continually move from indecision to clarity so that you can execute. A total share count number doesn't give you all the answers, because essentially when you acquire a share or it's vested to you, the date, the basis of that share is based on that particular date. So if you received it 10 years ago, there's a lot of embedded gain in an individual lot. So essentially the entire pool of your assets are made up of each individual lot or purchase based on your vesting date.
The timing of the grant is less important than the numbers behind it. What we're often doing, a client will look at it and say, I own 100 shares with an average share price of $50. And I would say that's lazy. What they're really looking at is they're saying, well, I've got X number of shares at $25 a share and X number of dollars at $75 a share. We would look at it and say, there's reasons that we should be selling the higher cost or the lower cost version, depending on what strategy we're trying to deploy at a certain point in the year or at a certain tax bracket. So looking at things at the lot level changes and gets more surgical, gets more exacting. If a client's saying, I'm wildly uncomfortable with my percentage, but I'm also uncomfortable with where I'm at as the tax bill, then you would start selling your higher cost, lower tax shares. Client is the opposite. Client has a charitable intent and they're saying, hey, I want to use appreciated securities to fund a donor advised fund. You gift your lowest cost basis shares to your donor advised fund.
Just to add on to that too, short-term capital losses are actually higher up in your sell sequence than long-term capital gains. So short-term losses, long-term losses, long-term capital gains, short-term capital gains is a sequence we want to sell in. So there could be the earlier stuff, because it's more volatile, we could actually record losses there in those particular vests.
If your advisor isn't looking at stock compensation and doing the necessary tax planning down to the lot level, like we just demonstrated, again, let's connect and understand how can this form of compensation serve the greater picture of what you're trying to accomplish as a family.